Thank you, Anton. Welcome, everybody. Thanks for coming along today. And there's a large contingent of the IML staff here as well. So if you can think up some tough questions, we can even share them around later. I'm going to talk a little bit about how we see the economy at the moment and the outlook, what it's like to be a company in the world at the moment, and where we're positioning our portfolio, and give you some stock examples. So we put this slide up, pretty much the same slide for several years. Is it because we've got no creativity whatsoever? We just put up the same slide? Or is it because actually things haven't changed? Well, the market seems to think that things are getting better. I think this is becoming quite a contrarian view. Everyone thinks that there seems to be a whiff of recovery, maybe Tony Abbott and Joe Hockey getting elected has made people think, certainly business confidence indicators are up in Australia, and maybe people are thinking finally at last we're going to get some strong growth around the world and here, and it's reflected in the prices of a lot of companies that are exposed to the economy. We don't see it that way. It's hard to see such a big recovery. And if you look at the US, sure, it's not in recession anymore, but it's the weakest recovery on record. Since the recession associated with the GFC, unemployment's come down, but not markedly. A lot of people are still looking for a job. And the economy's really been pretty sluggish in Europe. They've just had their first positive GDP print in ages. It was hardly anything to write home about. China's growing, and it's been very impressive. You go there, you see all these high-speed railways and think, oh, if only Sydney had a half of this infrastructure. But they built a lot, and it's hard to keep up that pace of growth. It seems to be slowing a bit. And at the moment, what we've got is very low interest rates, and that seems to be what people are relying on to keep growth going. Around the world, if you look at what's happened over time, we've had a big fall in interest rates over the past 20 years. That chart that you can see is for the US treasuries, the US bonds, but it could be the Australian market, a different scale, but the same shape. And it's as inflation's come off, so interest rates have come down. That's a big boost, been a big boost to the stock market. If people have said, oh, I can't earn that much money in the bank or in a bond, I'll buy equities. We've had a great big bull run in equities for the past 20 years. It's been punctuated, as Anton said, with plenty of hiccups. The tech crash, the GFC, but overall equities have gone up, and they've gone up not just in price, but the valuations have risen over time. But one of the things that's happened as interest rates have come down is people have said, oh, it's not so expensive to borrow. And so people have taken on a lot of debt. But over time, if you look at what's happened to debt as a percentage of household income, or I could show you a chart of debt to GDP, households since the early 90s have taken on a lot more debt. And you look at more recent times, the last 5 years or so, it's gone flat. About 150% of disposable income where households no longer are taking on more debt. And there are a number of possible explanations for it. As usual, economists never really know what's going on, but they pretend they do. I have a qualification in economics, don't worry. And the reason we no longer are taking on debt is either we've got enough already. I think that's a pretty good reason. Another reason is people are getting older. And as we have an aging population, and as people get older, think about it, when are people most likely to take on debt? Well, when they've got time to pay it back. Unless you're Alan Bond or Nathan Tinkler, most people don't like having debt. So people take on debt when they're young. They don't have that much in savings. They want to buy a house, a fancy engagement ring, whatever. And so people take on debt. But as they approach retirement, the last thing they want is to no longer be earning an income and have a whole lot of debt to service. So people buy their golden years, so to speak. As people are getting older, it's more like platinum years or something, are wanting to have their debt paid off. So as we're getting older, it seems to me it makes sense that we're no longer accumulating debt as much as we were before. It actually doesn't make sense to me that we took on so much debt in the first place, because I'm Mother Grundy in a young man's body. But I'm not one for debt personally. I don't know why people like it so much, but they do. And we've taken on a lot of debt. A lot of people feel that their debt levels are too high when they do consumer surveys and so forth. Another way of looking at debt is to look at the thick line at the bottom, the credit growth. And if you look at credit growth over time, you'll see that certainly in the 90s and early noughties, it was sort of between 10 and 20%, somewhere around 14, 15% a year. And then more recently, since about 2006, it's fallen to the low single digits, about 3 or 4%. And that's another manifestation of that upper chart. You know, in the old days, we were accumulating debt much faster than income. Income's growing at 5% a year. Credit was growing 15% a year. So we became more leveraged. Now, our sort of leveraging isn't our leverage isn't going up because our credit growth at 3 or 4% is around our income growth. So we're taking on more debt as a society, but only in line with the extra income that we're earning. So someone said to me in Perth last week, well, when are things going to normalize? When are we going to get back to that old, what looks like a pretty solid established trend of 10, 12, 15% credit growth? And I don't think he got the answer he was looking for, because I said to him, we're not. As far as I'm concerned, we have normalized. In dropping from credit growth in the double digits to the low single digits, that is the normalization. This is normal. Normal is not borrowing more than you earning. Joe Hockey even said it the other day. Not to me in person, of course. I'm not that important, but he is reported as saying we cannot keep living beyond our means. We cannot keep borrowing more than we're earning. And that applies to households, it applies to governments. And around the world, this chart is for Australia, but around the world I can show you charts for the US, I can show you charts for Europe, and it varies between countries as to whether it's the households or the government. But around the world, we have a problem where we've been accumulating so much debt, and it's almost as though the system has just kind of got to breaking point. And the GFC was the manifestation of that. But even though we've had the GFC, debt levels haven't fallen. And that's one of the problems we've got. In order to really grow, I think we need the debt levels to come down, because people aren't going to want to spend up big time when they have so much debt. Governments can't spend up big time, even though they'd like to. It's very popular with voters to promise them all sorts of things and spend a lot of money. But you can't, because the bond buyers don't want to buy your debt if you're Greece and so on and paying people a pension at age 55 because they've had a hard life as a hairdresser. And that is the sort of sea change that's happened. Is no longer is debt perceived as a good thing. Too much debt, people are now starting to say, investors, people who've saved up money don't want to lend money to people who are profligate in their spending and taking on too much debt. So we're in a new world, a very much lower growth world because of those lower debt accumulation rates. And heaven forbid that debt comes down sharply, because then obviously it would probably be associated with a global recession. And summarizing what I've just been saying, in case anyone nodded off, was it's going to be pretty subdued growth. It's going to be a tough environment for companies as a result, and it's going to be hard for companies to achieve earnings growth. The average company is not going to achieve earnings growth every year the way it was possible to do when we were growing credit at those sort of mid-teens growth rates. And it's a very selective environment, so pick your fund manager carefully, someone who you think can pick stocks. Sure, you'll have periods where the whole market goes up. There's a rising tide that lifts all boats. The past year has been pretty much like that. But the average year is not going to be like that, because earnings growth is not going to support company share prices just going up willy-nilly. It'll only be companies that are really performing. One of the other things that's been happening is that not only are we not spending at the same rate that we used to, because we're not borrowing to assist our spending, but the nature of that spending has changed. And the spending has been shifting from discretionary expenditure, towards non-discretionary expenditure. And non-discretionary stuff is the sort of stuff you don't really want to do. I mean, it's things like paying your electricity bill. Well, you want electricity, so you pay the bill. I don't think anybody says, "Ooh, whoopee, electricity bill, that's retail therapy, let me go and pay for that." The way they do when they get a new handbag or a new watch or a pair of cufflinks. And that spending change makes it quite hard for a lot of companies that used to rely on people buying unnecessary fripperies and trinkets and whatever, because people have shifted their spending to that non-discretionary stuff. And if you look at the grey line, the discretionary spending has been weaker than the non-discretionary, the blue line, for several years now, and most recently a lot weaker. While the non-discretionary has been fairly constant, it's held up pretty flat. If you look at that discretionary spending, not only has it been quite weak, it was holding up in services. Goods, maybe because of the strong Australian dollar, everything's made in China or Vietnam now or Bangladesh, so it was cheap in Australia to buy goods. That overvalued dollar was helping, and so the grey line actually went negative. We were spending less on goods at one stage, and I think part of that's the price effect, and we are spending our money on services, things like a restaurant meal, a haircut, a massage, something like that, travel. But you can see both have actually started falling, and so it's a tough environment for people hoping that they're going to get some discretionary spending. Whereas you can see this chart showing you the pain spend, that non-discretionary spend, things like healthcare. Well, you get old, are you going to say, "Oh no, I won't have the operation, I'm rather going to get a pair of new shoes"? It just doesn't work that way. People have to spend this money. Healthcare costs keep going up, but it's one of those things. It's not a choice. If you want to stay healthy, you're going to spend the money. You've got to pay your taxes to the government. You've got to pay your electricity bill. The water bill's all going up because we had to build desalination plants because it's never going to rain again, and that sort of thing. One of the other things going on in the economy is that we've had a big mining boom. It's been great for Queensland and Western Australia. You go and look at house price in Karratha or Gladstone, I think you'll get a sense that perhaps there's been a little bit of a boom there. But if you look over time, I mean, for many, many years, over 100 years, mining investment as a percentage of GDP was less than 1%. And even more recently, it's gone up, but only very recently has it gone up so sharply to over 7% of GDP. And already we're starting to see the miners are no longer investing in new projects. We had a lot of LNG plants off the northwest coast of Australia and also at near Gladstone on Curtis Island. We've had a lot of iron ore expansions and so forth, coal expansions, and that seems to be coming to an end. Sure, you'll get the production from that. That'll be good for the Australian economy, but that mining investment phase is very much long in the tooth, and I don't know at what rate it's going to come down. I don't think that 7.5% is the new normal, like it is with the credit growth. The end of the chart was the normal. This looks like an accident waiting to happen, and I'm not sure what's going to fill the gap. So that's another headwind for the Australian economy, unfortunately. The reporting season, well, it reflected some of these themes. You had sector dispersion. Resource companies were struggling a bit because you're already seeing some of the mining services companies seeing a reduction in the demand for their services. People providing outsourcing and design and so forth to the big miners like BHP and Rio. Cyclical industrial companies, well, the economy hasn't been that strong. It's been pretty challenging for them. There's a lot of hope out there that things are suddenly going to get better. Perhaps they will. It's my suspicion that most people are going to get a little bit disappointed that the economy is not going to rebound at a fantastic pace next year or in the coming year. Just because we've had an election or whatever it is. Bank profits, well, unsurprisingly, if you look at how low the credit growth is now, and they are issuing more shares each year as a rule with DRPs and so forth, bank profits are pretty much flat. And as usual, if you pick the right stocks, there are a few stocks that are doing well, and that's what we at Investors Mutual, of course, trying to do. This is our positioning. As Anton said, we've got a very distorted index. About 40% of the index is in banks chiefly and financials. You've got a big weighting in the resources. And we're not scared to differ from that index if we don't see particular value. And I don't, at the moment, we have been wrong for a little while, but at the moment we're not seeing great value in the banks. They've had a great run. People are chasing the high yields, but they're also taking on the associated risk that comes with investing in a bank. That risk may not materialize anytime soon, but it nevertheless is there. And you can see we're also underweight the materials. We tend to be more overweight in the stocks that are actually more exposed to that pain spend, the healthcare and utilities. Consumer discretionary is mostly gaming, which is maybe not pain spend, but it's pretty defensive type spending. People don't seem to worry too much about whether they gamble or not in tough times. They're always hoping to make some sort of gain. This is just a little bit more about the banks. The banks' bad debt charges, we've had a fairly benign environment. They're almost as low as they can go. So there's not going to be the upside, the tailwind to their earnings from lower bad debt charges that there has been. And that's one of the reasons we're underweight the banks. Another factor is if you look at history, you'll see how quickly they've grown their loans. The top chart is the top area, the blue area is the 16% housing loan growth. But if you look at more recent times, you'll see that growth has slowed. The non-housing loans, similarly, that growth has slowed. And it's probably going to continue to slow for some time yet. As I said, there's a combination of how much debt people have, demographics as we have an aging population. And the other thing is also just the sheer size of the pie. There's so much debt out there, the percentage growth on that huge amount of debt is naturally harder to achieve because you've got a very big base that you're trying to grow off. If you look at the valuations of the banks, they're pretty ritzy compared to where they've been in the past, particularly when you consider that in the past the banks were growing fast because the credit growth was so fast. Now you've got very low credit growth, and yet the valuation multiples are as high, or in some cases even higher than they used to be during times when the banks were able to do a lot better. Cyclical companies, I mentioned, these are companies sensitive to the economy, companies like Qantas or Boral. These are at a high level relative to history. We don't see a lot of value there. Obviously, we look at each stock individually. And you can see also, if we just compare their PE relative to the market, that's at a pretty high level relative to where it's been historically. Now, I just wanted to talk a little bit about, I've mentioned how stock selections are key, and Anton said how we focus on quality, and we really do stick to this and have stuck to this for a long period of time. Quality to us is really important. A lot of other value managers just look at value in terms of cheap price. And I'd like to give you an example of a sort of pair of companies that when I joined IML and I started working with Anton at the beginning of 2010, one of the things I did, we had a small holding in QBE that I sold, and I bought more CSL. And if you look at it, you'd say, well, as a value manager, these are two big international global companies. Why you sell the cheap one and buy the expensive one? The cheap one on 13 times. They were both at the time earning about $1.90 of earnings, 185, 190. There's not much in that. But you could get QBE for about $5, $6 less. So obviously it's cheaper. Same earnings, higher price. For CSL, same earnings, cheaper price for QBE. Why sell QBE? And the reason was, and the reason still remains, I believe CSL has quality. Hopefully no one's sitting here from QBE. Anyway, you're about to get your lunch, you can just chew on it and not pay any attention to me. But I believe CSL is streets ahead of QBE in terms of quality, not just slightly higher quality. It's at least double the quality in my opinion. So even though I had to pay a bit more to buy some more CSL, because we had some in the portfolio already, I thought that's a decision well worth taking. Now obviously I'm showing you this slide because it's worked out well, but it is the truth that actually in early 2010, I sold QBE, the record will show, and I bought CSL. And if you look what's happened now, QBE's had some problems. They had to raise equity. More shares means their EPS has struggled to make any progress. In fact, they've gone backwards to $1.15. Where CSL's grown fast, they've got a fantastic business. I'm going to talk a bit more about it in a moment. And their EPS have gone up to $3.10. So unsurprisingly, as QBE's earnings have fallen, so has the share price. I still don't think it's sort of, mouth-watering value. It's still on 13 times. Share price is down to $15 or thereabouts. Whereas CSL has gone up to $67. The price-earnings ratio is a little bit higher than it used to be, but to my mind, not bad value for a company of its quality. So picking the right stock, being selective on quality is much more important than just picking the cheap stock. And we've avoided value traps like Billabong, and QBE is one of those over time, not just looking at the headline price, but looking at what is that business really worth. So to tell you a little bit more about CSL, CSL has been listed for almost 20 years, and in that time it's had one CEO until just recently, and that CEO is Brian McNamee. If that sort of name sounds familiar, his brother Paul was an Australian tennis player. Brian plays a pretty mean game too, I'm told. A very competitive individual, ran the company outstandingly, because if you look at their compound annual growth rate in EPS over 20%, I'm sure you wouldn't need more than the fingers on one hand to count the number of companies in Australia that have a 20-year growth track record of that sort of magnitude. It's absolutely outstanding. It was a government entity called the Commonwealth Serum Laboratories, and they have expanded, grown in the international blood products business, and they also make vaccines, like the swine flu vaccine a few years ago was made by CSL. Blood products are using the blood that's collected, say by the Red Cross and so forth. You get blood from people's donations, or you pay for that blood in the US, and then you fractionate that blood. Fractionation is like using a centrifuge, I imagine, and you extract various fractions or various portions of the blood, and the proteins in that blood can be used in a lot of therapeutic applications. If you have an immune deficiency, getting a treatment of blood proteins from other people with good immunity can raise your immunity. If you have hemophilia, which means that you bleed when you get a cut and the bleeding won't stop, and you take one of CSL's products of other people's blood that does have the necessary characteristics, your blood will coagulate and you will stop bleeding over a reasonable short period of time. CSL's come out with a new product. This is our analyst who's sitting at the back there, smart fellow, tells me it's like Drano for your blood. It's called RHDL, and what it's used for is it's not yet on the market, unfortunately, so don't rush out to McDonald's just yet to sort of clog up your arteries. But when it does come onto the market, it will be a very material product for CSL if it does come on. It looks like it's going to. And what it's done is if you have a heart attack, normally you survive your first heart attack and you normally die on the second one, unfortunately. And the likelihood of a second one is quite high. But they have this Drano for the arteries, a blood product that you take if you have a heart attack, and that clears your arteries so that you don't get that blockage again. And it stops you having the second heart attack. So that could be a very big product. One of the things we really like about CSL is the amount of money they spend on R&D, $390 million. It's all expensed, and it's growing every year. This year it'll be more. And that is really their investment in the future. They keep developing new products, new applications of existing products. And because they're getting these products from the same basic raw material, which is blood, it's extraordinary. The different fractions of blood can be used for different products. They sometimes don't have to spend so much on a new product. Well, they have to spend a lot on developing, researching it. But in terms of producing the new product, often it's there already. They've just got to find an application for it. And they're very good at managing their costs. They've got the lowest costs in the industry, and they've got this wonderful growth profile. Now, it's hard to tell exactly what it's going to be each year, but as I said before, over time, it's averaged over 20% a year. So it's a very high-quality business. As you can see, we bought it at a PE of about 15 times in middle of 2009. I was working separately from Anton at the time, but we were both buying on similar days, so we both identified the opportunity at the same time. It's a little bit freaky. And as you can see, the valuation has gone up a little bit over time, but it's not in any way out of line with where it's been in the past, whereas a lot of companies now, because we've got a somewhat frothy stock market, are trading higher than they usually trade. Another company I just talk about briefly is TATS, which operates the lotteries in several of the East Coast states. They don't have Western Australia because that's still a state-run lottery. And they also do wagering in Queensland and South Australia, Northern Territory. Wagering is the sort of dogs and the horses and the trots. All of you would know about the lotteries. They bought the New South Wales lottery, and they've been running that, Powerball and Oz Lotto and so forth. And they get great scale benefits because you've got it's mostly a technology business, a marketing and technology business. And it's one where you're sure of making money. Obviously, all the money people put into their lottery tickets, you take your clip, the government takes its tax, and then what's left goes in prizes. So you always make money. It's just a question of how much. And they get scale benefits because they're able to use their technology in the new jurisdictions they've gone into. They were running the Queensland and Victorian lotteries, then they won the New South Wales lotteries, and they could use their technology here just the same. Then they won the South Australian lotteries, they can use their technology in South Australia. And so they get scale benefits. The other good thing that's happening is people are going online to buy lottery tickets or lottery numbers, and that cuts out for TATS the need to pay the news agents to sell the lottery tickets. People are also going online to do their betting, wagering and so forth on the horses and so on, and that's also a cheaper distribution method for TATS. Over time, it's grown at a steady, not nearly as a spectacular pace as CSL, but it has grown. And as you can see, outperformed the stock market nicely since we bought it at the beginning of 2010. It's got a nice dividend yield, over 5%. That's pretty much comparable to what the banks are paying you, but to my mind with a lot less risk because they don't have the leverage that a bank has to a possible shock or some bad times that could, at some point, don't know when, occur in the economy. So just talking briefly about our flagship fund, which I manage roughly half of. Since inception, we've delivered outperformance that I think Anton can be pretty proud of. Obviously, I've only contributed over the last 3 or 4 years of nearly 3% per annum. That's after fees. Don't compare that with funds managers who tell you numbers gross of fees. And that's been done with a very steady income stream. Income's an important part of return over time. You can see total return of 12%. The market's been less than 10. 10 is a good return number. And about half of that is income, half is capital gain. And shares do deliver quite steady income. Jason will talk more about that when he talks about the equity income fund. And just on income, you can see that even though the environment's been quite tough, a lot of companies haven't been able to grow their earnings. The sort of companies that we would consider owning and might feature in our portfolio are there. Industrial companies that have a reasonable quality. We own some shares in all of these, and you can see that they've grown their dividends over the past year. And in the case of the healthcare companies, Ramsay and CSL, they've grown their dividends very handsomely indeed. One of the consistent traits of IML, as Anton said, we're always quite low risk, much more so than other managers. And one of the ways that we are low risk is when things aren't good, when the market goes down, 90% of the time we outperform. Doesn't mean we don't go down, but we always go down less than the market. Only 10% of the time do we have a bad month where it's worse than the market. Whereas you look at other managers, they only outperform half the time pretty much in a down market. So it's pretty much a coin toss for them. And if I could finish by giving a little plug for our concentrated fund. I've been running this fund for 3 years. It's just had its 3-year anniversary. It's been rated both by Zenith and Lonsec and has been given a recommended rating at first rating by both of those research houses. I don't think we could expect anything more because it's got a short history. So a recommended rating is pretty good as far as I'm concerned. I'm happy with that. So far it's delivered about 5% outperformance over the 3 years. And what the concentrated fund is, it's our best ideas and it's very index unaware. I don't have to follow the benchmark. As Anton and I both said, the benchmark is very heavily skewed towards financials and resources. And if you think about what a lot of your clients would have in their own portfolios, if people have direct shares, what do they own? The banks. If you look at surveys of what people own, often more than 50% of individuals' direct holdings are bank shares. And at times the banks are cheap and they're worth owning, but they're not always cheap. And so if you hug the index and you've got this big weighting in banks, then you're not getting much diversification by just having the average fund manager who's replicating the index. Whereas if you own this concentrated fund, there's a chance that when the banks are overvalued, the concentrated fund can have nothing in the banks because it doesn't have to follow the index, doesn't have to look at the index. It's our best ideas in about 20, 25 stocks. It can hold cash up to 20%. And unlike a lot of other concentrated funds, it's a very low risk fund. It's got a very low beta. Consistent with all IML's products, we're on the very low standard deviation end of the spectrum, very low volatility. And if you look at what's happened to the concentrated fund since it was launched, and concentrated fund is the blue line. Obviously, we're happy to show you this chart because the blue line's above the red line, which is the index. Both are showing the accumulation. And you look at what would have happened if you were sort of Barry, bad timing, or Ursula, unlucky, and you bought at the top of the market in about May or April of 2011, how long it took you back to where you started. It was a very long time, where that period of time there for the red line to go back to where it started if you were unlucky in your timing. Whereas if you bought into the concentrated fund, sort of at its higher, this line maybe should be back a bit, the drawdown was nothing like as much, and you got back to square one pretty quickly. And so it's a much more appealing fund for people who are not wanting to take on too much risk and who don't want to just replicate the index. Also, I should give a plug to In Your Packs is a new publication that we're issuing. I'm going to write the first few, then we might put one of the other analysts on the spot and get them to write it. It's called IML Market Musings. It's an absolute page turner. There are a whole 2 pages there. It's a gripping read on what's going on in the world economy. It's not investment advice. That issue, which was the sort of inaugural issue, is on deflation and inflation. I think that's a very interesting topic. It's going to be published 1 month or roughly 1 month after the calendar quarters. So it'll be July, October, January, and April. So the next installment, which I'm sure you're all breathlessly awaiting, will be out soon. And thank you for your time. With that, I'll pass on to Luke.